Mira, today we're going to be doing the financial statements and the notes to the financial statements. I'm going to be focusing more on Classwork 2. This is our Classwork 2. We are given this balance sheet here. It's not really the balance sheet, but it's the trial balance, obviously, with all the balances. The information provided was extracted from the accounting records of Star Traders. The financial year of the business ends in February of every year. This simply tells us that the financial year will start on the 1st of March of the previous. Obviously, we're just going to change the years here. The business specializes in selling components of various radio and televisions. Well, in this case, we are given capital amount, okay? And the capital amount is 952,800. Because I'm focusing more on preparing the statement of profit or loss and the notes to the financial statements, and I don't have capital and drawing, so I will focus more on what needs to go to the income statement. So what I've noticed here is that we've got a loan, because obviously interest on loan will go to the income statement. We've got equipment, depreciation will go to the income statement. We've got fixed deposits, interest on fixed deposit will go to income statement as interest income. We've got trading stock. Trading stock is 316,240, and we've got debtors control of 119,300. Provision for bad debts is 5,000. Creditors control will be 220,840. That will go to trading other payables. And we've got bank of 25,480, petty cash of 1,800, cash float, which is 600. And they gave us consumable stores on hand, which is in brackets, they put in packing material. That simply tells you that we had packing material last year that was unused, and therefore that was recorded as inventory. But this year will be part of packing materials available to be used. Question is, are we going to use all of it? So we're going to add that to the packing material that we buy in the current year. Then we've got sales. Sales is 2,292,660. We've got cost of sales of 1,066,880. You have debtors allowance of 29,520. Remember, in the income statement, you're going to subtract the debtors allowances amount from sales. So you will take the 292,660 and minus that 29,000. So you will simply minus this 29,520. We've got rent income. Please note that everything that appears under nominal account section represents, if it's income, it has been received. If it's expenses, it has been paid. Okay, if it's income, it has been received. If it's expenses, it has been paid, unless we are told otherwise by the adjustment. So rent income we have received for the entire year is 247,650. We've got commission income of 22,680. We've got discount received of 7,620. Interest income on overdue debtors of 19,600, as well as interest on fixed deposit of 10,000. Those two will be part of your interest income. You won't record them under operating income, but you will record them right at the bottom of your statement of profit or loss. And then we've got bad debts recovered. Bad debts recovered, please don't confuse that with bad debts. Bad debts recovered is simply bad debts that was previously written off, and when we recover it, we record it as income. We've got discount allowed, we've got legal expenses, salaries, packing material. So this packing material, 14,000, is increasing what we already have from last year. So in total at the moment, our packing material is 54,000. But remember, we're going to expense what we have used. Advertising is 39,240. Bad debts is 10,000. Remember, bad debts will be increased by any debt that we write off. Okay, and then we've got repairs, we've got interest on overdraft. Please note, interest on overdraft is interest expense. It will be written at the bottom of your income statement as such. And we've got sundry expenses and depreciation, which is given to you in this case. Let's go straight to adjustments. And the adjustment says no entries were made. Highlight, no entries were made. Okay, for goods sold on credit. So this is a credit sale. So goods sold on credit for 11,200. The markup is 75% on cost. So this was not recorded. And remember, the sale of goods affects four accounts. It increases sales on the credit side. In this case, it will increase debtors control because it represents credit sales. So more people will owe us. Both of those will increase at cost price. Debtors control is an asset. It will increase by 11. I mean, it'll increase at selling price. Both of them will increase at selling price. Debtors control represents people that owe us. So more people will owe us. In this case, they will owe us the selling price. They can't owe us the cost price. The selling price is 11,200. So debtors control will increase by 11,200, as well as sales. Sales will increase by 11,200. So your asset debtors control is affected. It goes up on the debit side, and your sales, which is income, is also affected. But income, remember, it's minus plus. It increases on the credit side. Anything that increases owner's equity will increase on the credit side. So both of them will increase by the selling price. Those are the first two accounts. The other two accounts that will be affected will be cost of sales as well as trading stock. Cost of sales is an expense. It will increase on the debit side by the cost price, and trading stock will decrease on the credit side by the cost price. That is because you have sold stock. And remember, we follow historical costs when it comes to your assets. In this case, your trading stock will decrease by the cost price of stock that was sold. Obviously, when you get to us, it is a different story. You will know that inventory will be measured at your net realizable value. That is for next year or when you get to university. Okay. Now remember, every sale affects those accounts. The same with any allowance. If we have any debtors allowance, it will affect those four accounts. It is just a reversal of those accounts, except that the reversals of sales will not be debited to sales. Instead, we're going to debit debtors allowances. So if the reversal of sales is debtors allowances is just a control account for sales. Okay, it represents the selling price of goods that we return. Let's just analyze it through the workings first before we go any further. Now, in our workings, which is working number one, how do we account for that? Okay. It's simply an omitted invoice. An omitted invoice means that you need to do the right thing and record it. So how are you going to record it here? You're going to look at the cost of sales will increase by the cost price. As I mentioned earlier on, sale and trading stock will decrease by the cost price. And the cost price in this case is what you want divided by what you're given. Since you are given the selling price, you will simply multiply by 100. 100 represents the cost price, but the selling price is already at 175 because we've already added the markup to it, all right? So that is why we multiply by 100 and we divide it by 175, and that gave us a cost price of 6,400. Remember, sales entry affects four accounts. As I've mentioned, it's sales and cost of sales it's sales and debtors control at selling price, cost of sales and trading stock at cost price. How do we record this again in the income statement? Remember, I mentioned earlier on from your sales figure 11,200, which represents extra sales. Now your sales amount will be 2,274,340. Take it as 1,066,880. You're gonna add whatever you do to sales, you always do to cost of sales. You're gonna add the cost price of units that were omitted, that you sold but were omitted, which is 6,400. So we have 6,400 added as cost of sales. Your cost of sales figure will go to 1,073,280. Note that cost of sales are an expense. Therefore, you're going to put it in brackets and you're going to subtract that figure from sales. And you need to remember, when you take your sales figure and you minus your cost of sales, you'll get your gross profit. In this case, your gross profit will be 1,201,016. Okay. That is the first transaction. Let's go to the second adjustment and hear what it says. The second adjustment says an EFT payment for 2,800 was received from the insolvent estate that is supposed to be estate of a debtor as a final dividend of 0.4 rands, which is 40 cents in the rand. The balance must be written off. Please note that that 2,800, it's not what the debtor owes. Instead, it is what we have received. So it represents the 40 cents that we have received. It doesn't represent the total 100% that a debtor owes us. So how would we calculate the amount that we need to write off? You will notice that we have to write off 60 percent or 60 cents in this scenario in the rents. 60 cents in the rents will simply be 60%. Now let us look at the workings and how we work this one out. We have bad debts. We have to work out bad debts. The 60 cents will be the bad debts. We have to write it off. But we are given the amount received. We don't know how much this person was owing at 100% of the debt that this person was owing us. If we were given 100% of the debt that this person was owing us, we're going to take the amount that he owes us and multiply it by 0.6. But we can't do that because we don't have it. Instead, we are given the 40%, which is the 2,800 that was received from this individual that is written off. So we're going to take the 2,800, we're going to multiply it by what we want. Because we wanted the 60 represents your bad debts, and the 40 represents the amount received, which is what we have. So it's always multiplied by bad debts, meaning that our bad debts must increase by 4,200. Actually, this is wrong. It can't be 4,000. Yes, it can be 4,200 because that is 60 cents. 60 cents is more than 40 cents. And then you're going to have debtors control must decrease by the same amount, which is 4,200. Note that this is the 60 cents. So when you add the 2.8 with 4.2, it'll give you the total amount that this person was owing us. Doing it quickly from my head, this person was owing us around 7,000 rand. So this person was owing us around 7,000 rand, which is 2,800. You're going to add it with 4,200. And the 2,800, for me to get it, I multiplied it by 60 and I divided by 40, and it gave me that 4,200, which is what our bad debts will be. So how do we record this? You're going to go to your bad debts, okay? And this will be found in the income statement under operating expenses. So under bad debts, we're going to have 10,000. You're going to add what you have to write off, that 4,200. So you add it because it represents the amount that we have to write off. It represents the amount that we have to write. Now you'll realize that our bad debts in total will be 14,200. You need to remember at the same time that your debtors control will have to decrease by the same amount because the amount written off was not recorded. We only recorded the 40 cents. We did not record the 60 cents. So we still need to reduce our debtors control. Our debtors control has already decreased by the amount that we received, the 40 cents, which in this case was 2.8. So you don't need to worry about that. Okay, let's go to the adjustments. Adjustments 3 talks about provision for bad debts. In case you don't know what provision for bad debts is, please check out the other video. I posted it not long ago regarding provision for bad debts. It tells you that provision for bad debts must be adjusted to 4,600. And if you remember very well, when we read the trial balance earlier, I said provision for bad debts was sitting at 5,000 rand. So the one that we've just calculated, and well, fortunately, as a matter of fact, here it's given to us, okay? It's given to us as 4,800. So we don't need to actually calculate it. So our provision for bad debts that is calculated during the year is 5,000, right? Okay. And you need to remember when you recognize provision for bad debts, the initial provision for bad debts, we just debit bad debts, we credit provision for bad debts, which is a contra account for debtors control. It increases on the credit side. So it's sitting at 5,000 rand. Okay. Now that provision, question is it correct? Remember, provision is just an estimate of what will be written off as bad debts in the future. So we want our provision to be as low as possible. And according to this scenario, our provision that has been calculated for us is lower. Okay, it is actually lower. Now, since it is lower, it simply means that we have to adjust the one in the trial balance down. When we adjust the provision in the trial balance down, the difference must be recognized as income. In this case, we're going to look at our provision in the trial balance balance was 5,000. So we have to bring it down to 4,600. Okay. When you bring it down to 4,600, the difference will be called provision for bad debts adjustment. Now, that provision for bad debts adjustment can either be income or it can be an expense. In this case, it's income because we are reducing the provision that is in the trial balance. We don't want it to go up, we want it to go down. When it goes down, that is good for us. It's good news for us. It means that we expected less debts to be written off in the future, and we don't want our bad debts amount to be higher. We actually want it to be lower. So since it's lower, that is good. We need to celebrate, and we're going to record that difference as income under operating income in the statement of profit or loss. Let's go to the statement of profit or loss. We're going to go to either income. We already have rent, discount received, commission, provision for bad debts adjustment. Need to show this in brackets as to how you got the 400 rand. So it's 5,000 minus 4,600. That gives you 400 rand. Okay, let's go to the next adjustment. For now, I'm actually focusing only on the income statement. I haven't been focusing on the notes. Let me quickly go to the notes. Please note that as you record each transaction, make sure that you also go to the notes and make sure that you record it in the notes as well. So you record it in the income statement and the notes at the same time, okay? With respect to what we've just done right now, I'm just gonna go straight to my trade and other receivables. Note that I have debtors control starting with inventory. My debtors control was sitting at 103,200, and now I have to reduce it by 4,200, which is the one that I have to write off. Okay, in this case, I'm sitting at 126,300. Provision for bad debts will reduce my trade debt, so my net trade debtors will be sitting at 121,700. Okay, I'll explain the top part later on. Okay, I'm just going to do it step by step right now. I totally forgot about the notes. When you record in the income statement, every transaction, you make sure you deal with that transaction at once and you don't have to go back to it, okay? So that's what we need to actually practice. Let's go to number 4. Number 4 says that stock on hand, according to stock count of physical stock taking on the 28th of February 2018, trading stock is sitting at 312,000. 440. Please note that this final amount that has been counted, you take it straight to your notes under inventories, okay? So under inventories, you might have noticed we have that 312. You don't even have to think about it. You just take it to your inventory and you put it as part of trading stock because that is the final amount of stock that you have on hand. And then they say 80% of packing material was used during the year. And remember I told you that we had packing material under the balance sheet which said consumable stores. Those are the packing materials that were not used last year. So for this year, we have to add it. So in total, at the moment, our packing materials are sitting at 54,000. They just bring your attention to that note that the reversal for packing material on hand on the 1st of March 2017 was not done. So basically, we were supposed to reverse it and recognize it and add it to our packing material that we've purchased. So as a matter of fact, we are supposed to have converted to an expense at the beginning of the year and add the packing material that we have purchased to get our 54,000 rate. And now from those 54,000 rand, we're going to ask ourselves, did we use all of it? Because only the used part will go to the income statement. The unused part will be part of your inventory. Now let's check the working out on that. All right, the working part of trading stock. Note that trading stock was sitting in the trial balance at 316,420. And then you should remember what I said earlier on about trading stock, okay? That was from the first entry. I said our trading stock has to decrease by 6,400. That 6,400 represents trading stock that was sold. And to get that trading stock that was sold, we took 11,200, we multiplied it by 100, we divided by 175, it gave us 6,400. So our trading stock is no longer sitting at 316,000, the amount that was given to us, 316,240 is no longer sitting at that amount. We need to reduce it because we sold some of it. So we're going to reduce that, the adjusted trading stock. Okay, the adjusted trading stock is what we have in our books, but is it the same as what we have in the warehouse? And when you compare what you have in your books and what you have in the warehouse, which one will be more accurate? The answer is easy, guys. The warehouse represents what you have. You physically counted it, so it's there. It's physically there. It's part of your internal controls that you perform to make sure that your stock actually exists. So we know that the stock that exists in the warehouse is the one that I just gave you now, which is 312,440. Okay, but the stock that exists in the warehouse must be exactly the same as the stock that exists in the books. But yet in this scenario, the stock that exists in our books is sitting at 309,840. So that is not accurate. Okay, it's not a true reflection of the asset we have, which is trading stock. So in this case, we need to adjust our books up because they're unstated. We adjusted up from 309,840 to 312,440, and that difference, the adjustment up, is what we call provision for, not provision, we call it trading stock surplus. And trading stock surplus is income. An increase, I'm sure you have noticed, an increase of your current asset somehow is income. Increase of fixed deposit is interest income. So in this case, assets results in income. Liabilities somehow are related to your your expenses. Okay, so there's a direct relationship between expenses and liabilities and income and assets. Assets, remember, generate income, and liabilities result in a reduction of those assets. And reduction of assets, mostly the reduction of your income is expense. Income is reduced by expenses. I hope this is making sense. I hope I'm not making it complex for you. So this is how we're going to deal with our trading stock. Okay. So we know that trading stock surplus. Let me just deal with that and finish it. So I'm going to go to my income statement. On my income statement, I'm going to have trading stock surplus. My trading stock surplus in this case now, which is 2,600, it falls under income. Let's address the packing material. Okay, please note something about packing materials. Packing is with the one that we had at the beginning of the year. Okay, I don't know what happened at the beginning of the year in. Okay, it's supposed to be at the beginning of the year, which is 40,000. So packing materials available for use is 54,000. Question is, are we going to use all of it? The answer is maybe. If we used all of it, then the whole thing would be an expense in the income statement. But now we didn't. We used only 80%. And 80% of 54,000 is 43,200. That 43,200, the one that is used is the one that you recognize as an expense. I repeat, packing materials used will be the one that you recognize as an expense. I'll actually record a lesson on that, on packing materials and trading stock later on, just to explain what is going on there. Okay, in this case, we're going to have packing materials. Our packing materials are sitting at 54,000. We only use 80%. 80% of 54,000 is 43,200. That 43,200 represents what we use. If you want to really break it down, it's made up of packing materials that we had at the beginning. The unused part will go to the inventory node. Okay, so the unused part will go to the inventory node. Let me quickly take it to the inventory node. In my inventory node, I'm going to have the unused part, which is what I showed you earlier on, and that will be the 20%. Okay, so that is the unused part. Okay, it's supposed to show you as unused part there. But anyway, I'll do it later on. So we have consumable stores on hand that go to inventory. Will Moving right along, it says here, rent was decreased, which is very interesting. Rent was decreased by 10%. Check out the video on rent increase and rent decrease. I did it sometime last year. And then if this confuses you, go back to that video, watch it, and then come back to this, okay? It says that rent was decreased by 10% with effect from the 1st of January 2018. This is on the 1st of January. So it means that for the last 2 months of our financial year, we were not paying 100% of rent that we used to pay. We were only paying 90% of rent. So, and then they make it worse. They tell you that rent for March was included. So it tells you that the rent income that we have in the trial balance is actually for 13 months. And that creates a problem because rent income must have been generated within the current financial year. Now, the part that has has been received for the next financial year can't be recognized as income. Remember, we need to disclose what's happening. We report what's happening in the current financial year. And we have earned only interest for 12 months for the current financial year. But in this case, it means it simply states that that 247,650 is actually not what we have earned, it's what we have received. So we received more than what we have earned. So we owe the tenant some money. We owe the tenant 1 month's rent, but that 1 month's rent must be subtracted from this for us to figure out what goes to the income statement, okay? And obviously that 1 month's rent is at 90%, but we don't know how much it is. So we now have to calculate it, okay? Based on the information that we have, and you gotta perform your mathematical skills here, all right? Now, let's break it down in working. So this is our rent income. Our financial year will start on the 1st of March 2017. It'll end on 28th of Feb 2018. I included Jan because Jan represents the month where rent actually increased. The green part represents what is earned. The red part represents what is not supposed to have been in income. It's basically what we haven't earned, excuse me. So the red part, it's simply that rent that we received for an extra month, which is for March. It's supposed to be 31st of March there. Okay, I'll fix these errors later. Now, this is the period where rent was at 100%, but we don't know how much rent was. So you have to bring in your grade 8 math skills. What we don't know in maths, we normally call it X. So our rent was X amount for 10 months. And then for the next 3 months, which is, remember, we actually received for 13 months. So the next 3 months, rent wasn't at X amount, it was at 90% of X. So we're going to take that and multiply it by 3. And obviously, you know as well from grade 8, when you multiply numbers first, and then the variable, you keep it that way. So if we were to come up with an equation here, we'll simply say 10x plus 3x times 90 will give us that 247,000 that we actually received, which is the total amount of rent we have received for the year. So basically, if I add those two amounts, this is what you're going to get. Please note that 3, when you multiply it by 90%, it will give you 2.7. And then the variables, remember, when you add in variables, you simply add their coefficients. You keep the variable, you add the coefficients. So you're going to say 10 plus 2.7, and that will give you 12.7x, and that is equals to 247,650. If you struggle with that, please also check out my maths videos. I think I do have some from grade 8. And in this case, you will simply divide by that 12.7 on both sides. You get x. Please note, x represents the rent amount before the reduction of rent by 10%. So that is before the reduction. That is before the decrease. After the decrease, you're going to take it and multiply it by 90% because it was reduced by 10%. And 90% of 19,500 will give us 17,550. So from the 1st of Jan, it was 17,550. For Feb, it was 17,550. For March, it was 17,550. The one for Feb and Jan, we correctly included them, but the problem is the one for March. That is not supposed to be there. We haven't earned it, so we need to take it out. It represents income received in advance. Income received in advance is a liability. It will be included in trade and other payables. So how do we record this? We are simply going to take our income, must be what we have earned in the current financial year. So rent has been overstated. We need to reduce it to get a true reporting of our rent income for the current financial year. So I'm simply going to subtract the 17,550, and I will simply get my rent income, which is 230,100. At the same time, I need to record that in trade and other payables. So in trade and other payables, I'm going to have income received in advance, okay, which was given to you. I need to confirm that it's 323,280. And now it's adding other things. I just wanted income received in advance, and now it's including other things that we haven't yet discussed. I'll come back to it, okay? So that's how we're gonna record rent. Rent will simply affect those two that I've said, and they will. Yes, and this is how we're going to record it in trade and other payables. We're going to have the income received in advance, which is 17,550. Okay, so we're going to have that 17,550 as a current liability. Please note that by the beginning of next year, we need to give the debtor either a place to stay or simply give them their money back. Okay, so we need to give a debtor either place to stay or simply give them their money back. All right. Let us move to the next item, which is about advertising contract. They tell you that advertising contract for 14,400 was paid for the period starting on 1st of January 2018 to the 31st of December 2018. So that is the 12 months from the 1st to December. But the problem is that our financial year doesn't run from the 1st of January until December. It runs from the 1st of March until 28th of Feb. So in essence, we paid for a contract that will only cover us for 2 months in the current financial year, and then the other 10 months will be covered in the next financial year. Remember, this amount, because it was paid, remember I told you that in the 12 balance under income, we have amount that has been expenses will have been paid, income would have been received. In this case, it means this 14,400 has been included in that advertising amount we have in the statement of profit or loss. And that amount was how much for advertising? It was 39,240. So that 39,240 relates to the total advertising expense we have paid. But the problem is that an actual expense, because there is 14,400 that has been included in that 39,000. We don't have to exclude the whole 14,400. You only exclude what doesn't belong to the current financial year. Let us look at the working series regarding look at this here. So how do we account for that advertising? It's not this one. It should be okay, so maybe this one here. I wonder what happened now to my slide. Let me just look for it quickly. So for advertising, I just missed my slide there. I had to retype the whole thing again. For advertising, look at the current financial year 17 up to 28th of Feb. But the problem is that this advertising expense of 14,400 was paid for these months here. It was paid from January 2018 until December. Only you realize that the part that only falls in the green is from Jan until 28th of Feb. The red one is outside. So we know that it was paid and 10 months is outside the financial year. The 14,400, remember it has been included in that 39,000 something. So it's okay that it has been included, but the problem is the red part. It wasn't supposed to have been included because that rent has not rent, advertising expense has not been incurred yet. So it's going to be incurred next year. So we prepaid it. In essence, the advertising agency that we paid still owes us the services for 12, another 10 months. So we're going to calculate what we don't need. So we don't need 12,000. So that in the current financial year. So we need to record it as trade in other payables as prepaid expense. Please note that there's 12,000 right from our advertising expense. So let's go to our income statement. And in our income statement, look at advertising. So we're going to take our advertising expense of 39,240 from that. It'll give us it'll give us 27,240. It'll give us 27,240. Let's get back to our adjustments quickly. Adjustment number 7 says payments in respect of internet services and telephone are included in sundry expenses. They're simply telling you that services and telephone, okay, it doesn't mean that those have already been paid. It means that they'll be recorded under one account, and that account is sundry expenses, okay? And then they specify that telephone account of 4,060 for February will only be paid in March. Remember, in the trial balance, I said to you, in the trial balance, let me just go back to it. You have a sundry expense. Our sundry expense in the trial balance is 265,200. That 265,200 does not include the 2,000 that we spoke about, because I mean the 4,060 we spoke about, because that has not been paid. Remember when I started, I said the expenses that appear here are there. The question is, was it supposed to be there? Was it supposed to be included under sundry? Was it supposed to have been included under sundry? I hope it didn't erase itself like it did. in the last one. Let's check if it was supposed to have been included. There we have sundry expenses for the current year. It runs until then, but the problem is that this expense here, okay, it shows something totally different to what. All right, for sundry expenses, just take note of this period here because so it starts on the 1st of February until the 28th of February. So we have an outstanding amount of 4,060, as I've said, that starts from the first. What is it? It's simply an outstanding telephone account that has been incurred. It has been incurred, but we haven't yet paid it because we have used the telephone services, but we have not yet paid for them. So it's for the period from the 1st of February until 28th of February. An accrued expense, therefore, we're going to record it as accrued expense. And other payables is an accrued expense, but we need to add it to sundry expenses because it means our sundry expense account has been understated by the amount that it will simply go to sundry expenses and simply total sundry expense of 269,260. The same accrued expense must be recorded in trade and other payables. So we're going to go to trade and other pay expense, and trade and other payables will be 4,060. Let's move to the next adjustment. It talks about commission on sales of 7,320 from TV Tech Limited is due to the business. So we have done services that we were supposed to have been paid for, but we have not yet been paid for them. So that's 7,320. It's simply recorded as such. Before we even record it as income, we're going to go to our workings and figure out what we have done in the current financial year. So our financial year is from 1st of March 2017 to 8th of February 2018. That's 7,320. It's simply need to receive it. So because it's due to us, it's income, but it's accrued income, and it has not yet been received. Or 4,060. That 4,060, because it has not yet been received, we're going to record it as an asset. It's due to us. It needs to be paid to us, and we're going to add it to our understated and our accrued income. It's simply a current asset that will be recorded in trade and other receivables. Now, out of profit and loss, we're going to go to commission income, which is 22,660. We're going to enter, it's going to give us a total commission income of 30,000. The same amount will have to be recorded in trade and other receivables as accrued income. And hence we're going to have accrued income of that 7,320. I included the prepaid expense. Remember, the prepaid expense was for advertising, and now including that 7,320. I did specify that the 12,000 for advertising we have paid it enough. When you add all the receivables, it will give you 141,020. Number 9 says the bookkeeper has correctly posted gross salary. Please do check my notes on gross salary. I will post them later. Gross salary is an expense, so that's the one we're going to include in salaries, and also include contributions because those are extra expenses that the employer has to incur. So it is what we normally refer to as TC, which is cost to company. Cost to company, it's simply your gross salary, the employee's gross salary plus contributions. So in this case, they omitted to record the contributions, which are simply as follows. They told you that the business contributes a third towards the pension and on rent to rent basis for UIF. So if pension is 3,000, it's 6,000 of that. A third of that, how do you find it? You will simply take the 6,300 times 1/3. That's a third. And when it comes to UIF, if I contribute 1 rand, the employer will also contribute 1 rand. So if I contribute, the contributions will be recorded in the statement or recorded in the statement of profit or loss. But before we record them, can I just show you how this works out? So for some salary expenses, we have the financial year as normal. So 1/3 of 6,200 is 2,100. That will be your pension contribution. And your UIF contribution by the employer will simply be 900. When you add them up, it gives you 3,000, which is so in total, that 3,000 must be recorded because it's an expense that was not recorded. The 3,000 simply must be added to salaries and recorded as current liabilities in trade and other payables as pension fund and UIF. So this is how we're going to split it. Remember, part was contributed by the business and the other was deducted from the employee salary. The deduction from the employee salary is it's deducted from the gross salary. It's not an addition of your pension fund as well as your UIF. So it's what the employer contributed plus the deduction and what the employer contributed plus the deduction to give us what we owe. We also owe SARS, but this was deducted from the employee salary, and all of those will be recorded in trade and other payable statements. So how do we record it in the income statement? It's just the contributions that we're going to record, which is part of salaries, and that's why we have 2,100 plus 900, and in total our salaries will be the deductions as well as the contributions are what we still also those will be recorded in trade and other payables. And that will give us our total trade and other payables. Number 10 says that a loan from Infinity Bank, interest is not capitalized. They told us the repayments including interest were meant from Infinity Bank is which is the end of the financial year, it's 152,560. So now how do we calculate that to you guys and the calculations as to how we're going to do it? Interest calculations. For my interest calculations, this is what our financial year is. Balance at the beginning of the year. Please note that this was given to you in the trial balance, and it's written that it's balance at the beginning balance, and that was 131,560. Please note that you will normally minus the repayments, which is 28,080, which is from the adjustment, and you will add interest, but we don't know whether it was balance at the end of the year. So 131,520 minus 28,080 plus X, which is interest, is supposed to give us a closing balance of 152,560. Now, how do we calculate X? You just do reverse operation. You will plus 28,080 and then minus 131,560. So you minus what's positive and then you add what's negative. And this is what you will get, which is your X. Your X in this case will simply be 49,000. Hence will be recorded in the statement of profit or loss. Take into account my interest income. In the trial balance, I was given interest income. If I'm not mistaken, it was worth 10,000. So I'm going to add it to the 19,600. Please note that that 49,120, I added it to my interest expense right at the bottom, 9,260, which was interest on overdraft, if I'm not mistaken. And we're going to add 49,120 to get our total interest expense of 78,380. Please note that you're going to put it in brackets because it's our expenses. I did talk about income, and they'll give us 29,600, which is our total interest income. We don't put it in brackets because it's income. Remember, in the statement of profit or loss, income we don't refer to as other operating income. So I'm going to take rent income of 230,100, added with a discount received of 7,620, added with commission income of 30,000, added with provision for bad debts adjustment of 400 and 600. That will give me my total income, which is 277,120. And then I'm going to take my gross profit and add it with other operating income. So it's 1,201,060 plus 277,120. That will give me my gross operating 1,755,300. I'm going to do the same thing with my expenses. I'm going to add my discount allowed of 9,060, add vehicles expense of 47,200, add packing material of 43,200, add advertising of 27,240, add bad debts of 14,200, add repairs of 26,400, add sundry expense of 269,260, add depreciation. Depreciation was given in the adjustments. You just put it there as it is. It will be 15,120. I put it before because it was given in the trial balance. When you add all of those, it will simply give me my total expenses and check my total operating expenses. I put them in brackets, which is 791,480. And then I'm going to take 1,755,300 and minus 791,480. It'll give me my operating profit. My operating profit will be 963,820. You're going to add that with your interest income of 29,600. It'll give you profit before interest expense, which is in this case 993,420. And then you minus your interest expense of 78,380, which which will give us 915,040. Please note that this is simply our profit. It does not really mean that we actually got that cash. Remember, some of the income has been accrued, some of the expenses are accrued. So this is not actually what we have in the bank account. It's what we have earned throughout the financial year. When we take all our expenses, we minus them from all our income, it'll simply give us our net profit for the year, which is the current financial year. Remember, it is the 28th of February 2018. All right. Please make sure you subscribe to the channel, and once you subscribe, you will get the link and follow that link to get these handouts, or just email me and I will send them to you. All I can say is,